Good afternoon, everyone, and thank you very much for coming on to this session. Today we've heard a lot already about quantitative tightening, central banks taking liquidity out of the system, and I'd be keen to get your views on how you think that impacts your kind of taking a global equity view of the world.
Well, thanks very much, and thanks everyone for asking me here today. I think it's absolutely fascinating that at a time when considering the influence of policy on markets and considering the bigger picture and the broader macro backdrop has become incredibly unfashionable. Just at the moment, in my view, when it's going to really matter. Because having had QE for so long and this persistent flow of liquidity into markets, we're now moving into a situation where QT is going to lead to a persistent ebb. And that's going to just be far less supportive. We've already seen it in all sorts of different asset classes already. So I would say Bitcoin was the starting gun. And then we've seen it move through emerging market currencies, through the Chinese equity market, through spreads, through commodities, now the oil price, rotation in the equity marketplace. So I can see it everywhere you look. And I think it just represents essentially a much less supportive backdrop. And I think this matters not just for equity markets, but also for the economy. Because asset prices are being used to drive the economy. They've pushed them up to drag the economy along. And so as they decline, I think that's going to affect the real economy far more seriously than perhaps people realise. And therefore I think moving from QE to QT is very profound and means that you have to take it into account in your investment strategy.
Nick, from your perspective, looking at the fixed interest side, I mean, does that mean that we're now in the era of structurally low interest rates, or do we think that the interest rates can actually go up a lot further? The Fed's indicating 3 next year. Now, where does that cycle end? Albeit we're perhaps only just at the beginning of it. So I'm asking you to forecast out quite some time, maybe.
Yeah. So I think when you think of it, let's be honest, central bank policy rates are just ludicrously low. They've set at a level that's suitable for an emergency. Are economies in emergencies? No. They're actually growing at a pretty healthy clip. So if you take the US, what you need to remember there is 4-3-2. 4 hikes this year. If we get December, that's 4, 3 next year, and then 2 in 2020. If you look at the UK, the average Bank of England base rate since 1700 is 3.5%. So can rates double from where they are now? Absolutely, and they will. The trickier one is Europe. And Europe's in a trap because they've done negative interest rates, which is a disastrous economic policy. It embeds a deflationary mindset, and of course they target inflation. And when you look at inflation in the Eurozone, it's at rock bottom levels. So probably the best you can hope for there is they go from -40 to 0.
And Ainsley, from a property perspective, obviously we heard about equity and fixed interest there. What impact does rising rates have on the commercial property market in the UK?
Yeah, I mean, historically, UK commercial properties operated quite well in a normal interest rate environment. So sort of, these sort of 3-4% rates. I think that from where we sit, we feel it's all about the strength of the businesses that are supplying the rent and how that operates as we go forward into a few small hikes. I think we don't think that would be detrimental. The yield on portfolios like ours is about 5% in terms of an initial yield against where bonds and the differential there. So we feel quite comfortable about it. I think an important element for us is that it's slow and steady as opposed to drama, because commercial property, quite often gets hit by the idea of drama more than in real terms what actually happens. So we're kind of sensitive to that and live to that, I think. So slow and steady for us would be fine.
Mark, from your perspective, and we heard this morning about some of the risks that are perhaps perceived in the supposed bond proxy stocks. I mean, how do you navigate those as an equity income investor? And then maybe James can come in after that, taking it from a global perspective.
Yeah, I mean, I've said before, I don't really like the term bond proxies because it's a bit sort of convenient for shorthand for stocks that have performed well in a low interest rate environment. Good companies that can grow their dividends, if they categorise themselves as bond proxies, actually are quite different from bonds, because you'll never get growth out of the treasury. You'll get your coupon, but you'll never get any growth. Good companies can grow dividends through whatever economic cycle we're in, and through whatever bond market environment we're in. I think that kind of the comparison is actually obviously to a certain extent misleading, given the qualities of good companies and what they can do with growing cash flows. In the case of highly valued companies that have become more highly valued as a result of low bond yields, I come back to valuation being the important driver here. Ultimately, am I inclined to chase highly valued businesses in the hope that they'll keep re-rating upwards in the face of higher interest rates? No, I'm not. And I do have some sympathy with the view, as we've already discussed, that as the risk-free rate from the US rises, everything else derates. And that includes highly valued businesses. Where I do think there can be opportunities is if valuations have become disconnected from what I think is fair, is a fair value.
And you've got a couple of examples of
I've long been a holder of tobacco stocks, which have performed very, very well, except for the last year and a half or so, a couple of years, and in part because of the move up in the bond yield, but tobacco stocks have derated substantially, partly because people are worried about kind of the end of combustible cigarettes. But actually, these stocks are trading very, very low in a long-term context, with amongst the best dividend track records anywhere in the market. So, do these represent bond proxies? Well, frankly, I don't care. Are they cheap companies that offer value at this point? Yes, they are. So, but by the same token, I'm not chasing up the valuation of a Unilever, say, or a Diageo, which has been bid up consistently throughout a low bond yield environment, because they offer more certain growth in difficult times. But these companies, to my mind, are too highly valued.
And James, from a global perspective, is that a view you agree with, or do you see something slightly different in different markets?
Well, in a sense, I slightly reject the premise of the question. I don't think we are in a rising rate environment. I think we have been in a rising rate environment, but I suspect we're reaching the end of that. And therefore, I would subscribe to the idea that higher quality businesses can continue to compound in the long term. They should form part of your portfolio. Completely on board with the idea about tobacco. I think they represent outstanding value today. But I also think there's a place right now in the portfolio for businesses which are a bit more correlated with interest rates. And that's the sort of negative aspect of it, potentially, if one's wrong on one of the rates view. But they're also not terribly economically sensitive. And if we are moving into a slowdown, those sorts of businesses will do terribly well. And the exciting thing about that, obviously, is you'll then be able to use that capital to buy better but more cyclical businesses as opportunities arise and as valuations improve, if things play out as I expect them to over the next coming weeks and months.
And Nick, if we are entering a slowdown, and James is saying we're not in a rate rising environment, how does that you view that from a fixed interest perspective? And maybe if the central banks are happy being behind the curve, does that represent quite a big risk to the fixed interest market?
Well, I think the evidence suggests, frankly, the opposite. You look at any bit of economic data, and economies are growing pretty strongly. I think the other reality is there's going to be a big supply of bonds, because as central banks around the world are tightening monetary policy, governments are loosening fiscal policy. So the US deficit this year will be 5%. If you think in Europe, the UK, the Italian, the Spanish, the French deficits will all be bigger. That's more bonds coming. To put a number on that, US Treasury supply this year will be $1 trillion. A year ago, it was $500 billion. So someone's got to buy, maybe these two gentlemen, all these new bonds. But again, there's a basic aspect of supply and demand there. So when you look at the bond world, not all bonds are equal. So personally, we'd be very underweight your government bonds. The kind of bonds you want to own are those bonds that do well in a growth environment. So the standout one there is a high yield bond. If you look at high yield bonds today, on average, they have a yield of about 7%.
Turning, Mark, to the UK. I mean, UK is a market we've heard today is very, very out of favour. Maybe politically unstable might be the kindest way of putting it. Perhaps more unstable since we've been sat here. Is the UK out of favour just because of Brexit, or are there other issues at play?
Well, I think the overlay has. I think the overlay in the UK has absolutely been political. Actually, the evidence of the economy in aggregates since the referendum has been, it's performed a little bit worse than before the referendum, but not significantly so. And actually, there is some evidence at the moment that things are improving. The government is putting money back into the economy. They talk about the end of austerity. I mean, we're tinkering with the numbers, but effectively there is more government. There is more government money coming back in, and I think the government stand ready to do more if they need to. So overall, the evidence to me is actually the UK economy is doing just a bit better than people had expected it would do after the referendum. Ultimately, though, global investors have taken the view, quite rightly, if you look at the events of today, politics is too hard to call. I've got a myriad of other opportunities that I'd rather be looking at elsewhere in the world, and therefore I will underweight UK equities relative to the rest of the world. Now, within the category of UK equities, there is a sort of subset. Those companies that are particularly exposed to the UK economy, those are the cheapest of all, because clearly there's quite a lot of global businesses that are quoted in the London market, but the companies that are exposed to the UK economy happen to be the cheapest of all, and I think that's really where the opportunities are the greatest. And now, on a day like today, when the currency moves as sharply as it has done, it feels like a lonely place to be buying domestically focused UK equities, and it's a bit of a rerun of the days after the referendum, what we're seeing today in microcosm. But I really do think that there's a lot of bad news discounted in these share prices, and actually fundamentally, as I said, the economy doesn't need to do a lot better for these share prices to be materially mispriced.
I mean, one of the areas that gets talked about a lot in the UK, Ainsley, is the kind of slow death of the high street. Or maybe the quick death of the high street. When you look
we've
at some
talked about
places.
the death of the high street for about 6 years, so finally we're feeling it.
Absolutely, and so therefore, from a property perspective, which obviously retail probably used to be a large part of the market, or a larger part. How do you navigate that from your positioning?
Yeah, I mean, on funds like ours that are so focused, I mean, they're daily traded, they're income style, anywhere where there could be potential erosion of income over a long period that could cause us serious trouble. From a fund style 10 years ago that would have been retail, industrial and offices, it's just completely diverse now. So we have loads of data centres, there's care homes, there's student accommodation, there's a whole variety of other styles of asset that have become part of a normal balanced portfolio. And the demographic, rides you through a lot of what's going on and the more structural changes. In terms of the death of the high street, I think you've got to be very nuanced and look at the grassroots, each asset by asset. Some areas are thriving, many are dying. Retailers have gone from sometimes 500-600 stores across the UK to 40 or 50. Many very mediocre retailers needed to go, and I find it refreshing that we're finally getting that coming through. Many areas are doing really well. I think the big risk areas are areas like big shopping centres, fashion park, retail warehouse parks, where people relied on fashion retailers to be the dominant in these parks. I don't think that there's necessarily a place for that, and these rents are very challenged. But we're spending more than ever. We're just spending it differently, and for us the big upside, and I think where we feel the trophy assets genuinely are in the fund, are that of fantastic logistics, really good last mile logistics, well placed footprints for the whole of the UK around the M25, a lot of southeast, and they continue to have, even this year, double-digit returns. So where you're seeing decline of outward yield shift on yields in the retail sphere, you're seeing wins still coming through in logistics. So it's about how you're positioned within the change that's taking place. I kind of welcome it. Yeah. It really needed to happen, and it will be down to a lot of these local planners as to how they address many particularly regional high streets going forward.
Mark, I was just going to add on the retail property. I mean, I agree. I do think it depends on the asset. It's interesting to note that a number of food operators are still opening convenience, because convenience is actually where people want to shop. So if it's Tesco or if it's Sainsbury's or it's the Co-op, for instance, they're opening a lot of convenience. Also, retailers, I'm a big shareholder in Next, and spent a lot of time with them talking about how they combine the best of online and offline. They still have roughly 500 stores in the UK, and they say to us, over 50% of all orders online are for click and collect. So they're not delivered to home, they're delivered to a store. They need a store base to do that, obviously, and more like 80% of the returns are returned back to a store. So again, they need to have physical presence. It might not be in the places that they are today, but I suspect we will have a high street for the foreseeable future, it's not going to look like it does today. And some of the storefronts, as you see, the fascias will change, businesses will come and go. But I do think that the death of the high street is significantly exaggerated.
Yeah.
And James, on the looking globally, thinking about perhaps volatility we've seen over the last few weeks, how has that played out from your perspective, from thinking about large cap stocks versus mid cap stocks, and perhaps the valuations that those different parts of the market are on?
We don't tend to differentiate particularly between large cap and mid cap at Troy. I mean, generally speaking, we'll invest in large businesses because they're nicely diversified by product type, by geography. They tend to be pretty robust, pretty durable. And businesses have been around for a long time. They're the sort of businesses we favour. Having said that, there are one or two ideas that we favour at the moment just because they're particularly attractive and we can invest in them. So I'm not sure you can make a big distinction between mid and large cap, but we are increasingly finding ideas as a result of what's going on in the market, which is exciting.
Great stuff. Well, sadly, we're out of time. So all it does is take me to thank the panel for their time this afternoon. If you could join me with saying thank you very much.